Welcome to our 2025 webinar series, A Universe of Insurance Planning. This year we'll stargaze at insurance situations that fee-only advisors like yourself closely encounter. You might explore the cosmos to examine your clients' risk factors and provide ways to safeguard their families and assets. And you'll learn about personalized insurance solutions that can adapt to their changing needs throughout the galaxy. In today's presentation, we will look at strategies from the thought-provoking book, Die with Zero, in which author Bill Perkins outlines his plan for optimal times and amounts to retire and the role insurance must play in any financial planning strategy. We'll lay a foundation of term and disability while clients are accumulating assets and then transition to long-term care strategies in the no-go years of retirement. And we'll look at creating lifetime income through immediate annuities at retirement or layering deferred income annuities along the way. Each webinar will last about 50 minutes, and you must be logged in for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We will answer all questions as best we can. Today's webinar is being recorded and will be posted on our website within 24 hours. Today's presenter joined LLIS in 2003 and assumed the role of CEO in January of 2013. Here to talk on insurance strategies to die with zero is CFP Mark Maurer.
Thank you so much, Valley, and thank you everybody for tuning in today. This is our first webinar of the year so far, and Claudia, who had been with us for a number of years, retired, and so Valley has volunteered, and she's doing a great job filling in some kind of big shoes. Actually, I don't know about Claudia's feet, don't know if they were big or small shoes, but shoes to fill, and Valley's just been a super help and doing a great job, and has brought some zing and life into my PowerPoint presentations. And so today we're going to talk about insurance strategies to sort of complete the die with zero. And I know this is a very popular book. A lot of people have read it. It's kind of a quick read by Bill Perkins, and just this idea of why do we accumulate a lot of money at the end of life when we could have used it to do other things, when we could have used it to enhance sort of our life, our experiences, all those other things. And so it's a fun book and highly recommend reading it. I don't get anything out of it if you buy it, but I enjoyed it. And so as I'm reading this, the whole idea, well, you hear die and being an insurance person, I think life insurance. And he mentioned some strategies along the way. He talks about annuities. He talks about long-term care. But sort of in the beginning, and maybe the first half of the book, there's just this assumption that you're working. And to me, in my mind, it brings me to think more about insurance and this idea of laying the groundwork. Everything that he talks about in the book, making an income, is an assumption. It's just baked in. The fact that at some point you will get to a point where you can retire and you have assets to retire on is an assumption. And so the income is like this basis, the floor, the foundation, this groundwork of all of these other things. So I love this pyramid. All of these things, from paying for my car insurance for my 16-year-old, all the way to potentially passing on money to him when I'm 98, and he's whatever that would make him, still really old too. All of these things are predicated on this idea that I'm going to work and earn my income. So what happens if I can't? What if I can't get to retirement age and I can retire with X to die with zero? So life insurance, disability insurance are going to protect all those years. And it's not really a book about insurance, but as I'm reading it, I'm thinking, there's insurance needs here in this part to get to retirement. And the whole book is about when you get to retirement, what is your number? What is your X to retire with, and then dying with zero, using up your money so that you can have maximize experiences. But if you die too soon, if you can't work, you never get to X, and you can't have X to leave to your family. So looking at space themes, some of these may be familiar to a number of you, some may not. Here we have William and Deanna, both are age 40, and he's a commercial pilot, makes about 150,000 space bucks. She's a psychiatrist, makes 250. And they have two kids, Neo, age 8, and Trinity, age 6. Yes, I'm mixing my themes here. So one of the first questions is, how much life insurance do they need? You all have more complicated, more detailed financial planning software that's going to give you a number. But if I was to meet William and Deanna and just needed a place to start, we look at multiples of income. There's human life needs and human life value and all kinds of calculations. But at the end of the day, all of those financial planning goals, all of that pyramid is going to be predicated on their income. If I'm making $50,000 a year, it's great if I want to pay for all 8 of my kids to go to Harvard, but I can't. So the needs, that pyramid is going to be based on the income. So my needs tie pretty closely to my income. So for up to age 40, most insurance companies will let someone apply for up to 25 times income. If we have a single income household, I lean towards higher amounts. If we have a two income and even a fairly evenly matched or good income household, then we don't have to necessarily look at those maximum numbers. But someone age 40 can get up to 25 times income in life insurance. Why? On average, we work to age 65, give or take. Again, not everybody works to age 65. Not everybody needs 25 times, but all of these are just numbers that we can use to start. So that's the amount. How long do we need it? Well, I look at what are the life events that I need my life insurance for. So looking at mine personally, my longest one down there at the bottom is goal to retire. And for William and Deanna, they want to retire in 20 years at age 60. So they plan on working at least that long. That's the goal. There's their retire with X. That's their hope. But there are other things where needs drop off, and all of a sudden, well, in 16 years, everybody's out of college. So any funding that I might have done, that need drops off. Once kids can drive, needs drop off. So I look at this as says, if we look at the left-hand side, for the next 8 to 10 years, I need the most, or William, Deanna need the most life insurance because they have little kids at home. Trinity and Neo, they can't drive. Maybe they can dodge bullets, but they can't drive yet. So we need a lot of income replacement at that point in time. But then once both of them can drive, needs for childcare drop off. Once they're both out of college, any savings I've been doing for college gets freed up. And so then I need just life insurance to retirement age. So we've looked at the amounts, how much does somebody need? And then this idea of layering coverage or layered tiered events for amounts of coverage needed or the time it's needed. So we'll look at William. He's a preferred non-smoker, and we came up with a number of about $2 million of life insurance. That's not 25 times his earnings. It's more than 10 times. So kind of like Goldilocks, just right. Or I guess space Goldilocks. Make sure I keep my theme in order. So $1 million of 10-year term, $439. $1 million 15-year term, 500, or it's 2.5. Did I say 2? 2.5 million. 2.5 and then 500,000 of 20-year term. So we have this layer. So one of the things that's cool about layering is that the shorter term costs less. So he can have $2.5 million for the next 10 years, and it costs $14.14 a year with all three of these plans. Now look at that, $500,000 of 20-year term, $414 is almost the same as $1 million of 10-year term. Almost double the coverage for the 10-year term, but it's covering the shorter term. So $2.5 million of 20-year term is probably going to be $2,000 a year in that range. So layering does a couple things. One, it costs less initially, that $14.14 to have $2.5 million right away. But then as time goes on, the coverage drops off. And so his premiums reduce even further. So after 10 years, both kids can drive. They really can dodge bullets now. Now there's $1.5 million for the next 10 years. But he's only paying $975 because that first term policy dropped off. Then for the last 5 years before retirement, now we're down to the $500,000 policy paying $417. So I love term layering for people, whether you're in outer space or here on Earth. It just is neat. It's tailored to the client, to their needs, and they're not paying for more coverage in the later years than they need. If you take it to the extreme, if someone's making $100,000 a year today, if William, he's making $150,000 today, does he really need $2.5 million the year before he retires? Is he going to make $2.5 million in 1 year that last year? No. But the value of his years of income today is. So it drops off as he has fewer years until retirement, the smaller amount of loss of income as he gets closer to retirement. Same idea for Deanna. Her income's higher, but we have the same ages of kids, same college funding, same hopeful retirement date. $3.5 million for her for $1,268. What do we notice about that? She has more life insurance and it costs less. They're both preferred non-smokers. So the only thing factored in here, the same age, same rate class, the only thing factored in here are that women tend to live longer, so her costs are going to be less. That's it. Same idea, same design here for Deanna. Kids, little kids, $3.5 million, $1,200 a year. Kids get out of the house. They're in college, out of high school. Maybe they're working, whatever it might be. Coverage decreases, probably paying for college. And then for those last 5 years before retirement, she's paying $476 a year for $1 million of coverage to replace 3 to 4 years of income, 4 to 5 years of income, not the 20 that we need today, the $3.5 million. And if anyone has any questions, feel free to type them in the chat box, and I'll try to get to them as we go along. That way, just in case there's something that somebody has a question on, probably somebody else does too, and that way I can make sure we touch all those. So we covered what happens if William and Deanna die before getting to retirement age. I keep calling it X. So Bill Perkins' book is Die with Zero, but you have to have something at retirement age. So I keep saying have X, retire with X dollars, so that you can die with zero. At some point, you got to spend down something. So I keep calling it X. So we have a life insurance in case William and Deanna die before getting to retirement age, before that retirement amount is fully funded. What if they're hurt, sick, injured, can't work? There's still a loss of income. Income's still not coming in either way. Actually, disability can be harder, because if I pass away, there's a loss of income, but there's no expenses for Mark. There's no expenses for William. If he becomes disabled, he's still there, still eating food, has grocery bills, but still has a loss of income. So disability can be even harder, even more important to have coverage. Now, being a pilot, pilots can't get individual disability coverage. It's an employer-provided benefit. There's very small things that someone could possibly not be able to work, something like just a loss of license, and so that's not going to work for William here for my example. But Deanna, being a psychiatrist, we definitely can. She's self-employed, like a lot of psychiatrists, psychologists, a lot of 1-2 person practices. She's self-employed, and she makes $250,000 a year. Of course, that's taxable. She's eligible for $11,680 per month in tax-free disability benefits. A lot of times I have the question, well, if she makes $250,000 a year, why can't she get $250,000 a year in disability income benefits? And there's two things. First off is taxes. So that's why I put taxable there. When she's going to pay for this disability, this individual disability policy herself, because she pays for it with after-tax dollars, if she became disabled, anything she'd receive is tax-free. And as I'm sure every one of you listening knows, a dollar of tax-free money is definitely worth more than a dollar of taxable money. So the fact that $1160 per month is tax-free compared to $250 taxable, if we start looking at that, it actually, if we assume a 15% tax rate, the $11,680 tax-free equates to about a 66, almost 70% replacement of her taxable income. So what does that mean? Long story short, disability insurance companies want their space insureds to have enough to live, buy groceries, pay rent, pay the mortgage, but not have so much to be so comfortable that there's no incentive to return to work. If Deanna could get $250,000 of income by being disabled, a lot of people are going to find, it's called a moral hazard, a lot of people are going to find a way to be too stressed, too something, to not go to work today because there's no financial loss at that point. I can not go to work and make $250, or I can go to work and make $250. Seems like it'd probably be a pretty easy answer. So that's why disability benefits are designed to cover a lot of things, but not necessarily everything, so that there's an incentive to return to work. So we looked at a policy for her. This is a design that I have on my own personal policy. Benefits to age 65, own occupation definition, a residual or partial disability benefit, and that 3% COLA rider, so that as she starts receiving benefits, benefits will increase every year that she's on claim. There's also a catastrophic disability rider. I really like this one because in worst case scenarios, loss of sight, loss of speech, loss of limbs, cognitive impairment like Alzheimer's, it pays an additional $9,000 per month to, basically with the idea that if someone is diagnosed with Alzheimer's, it's unlikely that they can return to work at their current capacity or maybe any capacity. So now we do get closer to that $250,000 because it's more likely that she may not be able to return to work ever again. And the monthly premium, $879 a month, which obviously nobody really wants to pay. Seems kind of pricey when we look at the disability coverage or the life insurance coverage, but the chances of a 40-year-old woman dying in the next 10 years is very small. chances of people becoming disabled, so still living, but having that injury, that illness that keeps them from working for a while is much higher. And we see it here in the costs. This is $11,000 a month for almost $12,000 a month times 12, so $140,000 a year, possibly over the next 20 some odd years. So we have all of those going on, all of that going on. So it costs quite a bit more. That's the sort of general design of a disability plan, one that we would look at sort of for full coverage. Then, because she is self-employed, I like to look at something I call sort of group-like. Most people who have group benefits, like William, aren't going to have what we call the bells and whistles, all the, every possible feature that you would have with a traditional disability plan. You have your group-like, and so we have the same monthly benefits. A group disability plan is going to have monthly benefits, 90-day elimination period, age 65 benefits. A group plan probably won't have own occupation definition, probably something much more restrictive. May or may not have residual benefits, usually it does some way, shape, or form, but it won't have, I don't know that I've ever seen a group plan that has that catastrophic rider. I haven't seen a group plan that has the COLA rider, and so I might take those out to lower the premium. And if we take out those two benefits, those just two riders, the only thing I took out, we lower the premium to $714 a month. Still quite a bit more than the life insurance, but definitely some savings, a couple $1,000s a year. So as someone who is self-employed realizes there's benefits with her being the primary earner, I mean, definitely they're definitely co-earners, but being definitely the primary earner, it's something to consider. And there are all kinds of levers we can pull. If they have a really large emergency fund, could look at a 180-day elimination period, a longer self-funding period of time, maybe $10,000 a month, and that's going to lower the premium. So lots of different things to look at. Question, so going back to the term layers, question, how do you address the layered approach might be impacted by inflation? And definitely, that's going to be part of that analysis. If I was really concerned by inflation, then maybe I wouldn't have that. I wouldn't have the policies reduce as quickly. But I still think in 15 years, somebody's income might increase, but I still think that 15 years from now, when you have only 5 years left to work, that's probably still have less of a need than you would do today. So my reduction is probably a little more linear, but I would still look at the term layer. It just may be that instead of the first 10-year term dropping off so significantly, it would be $500,000 of 10-year term, $500,000 of 15-year term, and $1 million or $1.5 million of 20-year term. So instead of sort of a much faster decline over time, it would be a much slower decline. So good question. All right. So we covered the working years, the earning years. How do we protect that period of time where we can get the clients to retirement age? If things go right, they have that insurance, never need it, and away it goes. If they do need it, then there was life insurance. There was disability coverage there to fill in under that to fill in the foundation of that pyramid. So we talk about that part when our younger earning years. And then Bill in his book talks about this idea of long-term care. And I like this I don't know, his rhyming, talking about when you get into retirement, you have your go-go years. You've just retired. Jenny here in our office retired at the end of the year. I think she's been to Europe twice, or if not, at least once, and then on a cruise right now, I think. So you have your go-go, all the things you want to do. Then slow go. Maybe you do some trips, but maybe they're not as many. Maybe there are places where you make sure there are stairs, with a good handrail. And then your no-go years. And Bill in his book, I think, talked about just where at some point all you want to do is stay home and watch Jeopardy, which I kind of want to do now. But that's you have your go-go, slow-go, no-go years. And so you have these expenses that are higher in our early years, and then travel, there's not going to be many expenses when we're in our later years. Our medical care, our medical expenses, higher in our no-go years than they're going to be in our go-go years. So all that's going to play into this. But Houston, we have a senior client. So we have our astronaut who's age 50. We just call him astronaut. Wants to retire in the next 10 years. Looked at the LTC portion of the Die with Zero book, because the book does talk about needing care, how we can use money now to fund our potential care needs rather than building a big pool of money later on to pay for those needs. So you're transferring risk. My risk is that I have to accumulate this giant ball of money that I might draw down when I'm 80, or I can use some of my income now to buy life insurance and or long-term care to be able to fund care needs. And this guy, he's always looking for a bargain, which really was just a way for me to pull in Dr. Strange talking to Dormammu, because I needed one more space theme. So any Avengers fans out there, you know what I'm talking about. But he's always looking for a bargain. So one of the things that we look to is the IRS. Probably words you've never thought of, looking to the IRS for a bargain, but may help with some deductions. So what can people deduct? An individual person, non-business owner, can only deduct long-term care premiums if they are itemizing, and only the amount above 7.5% of their AGI. And for long-term care, you have this age-based limit. So regardless of if your policy's $3,000, $4,000 a year, for someone who's 55, they can only use $1,800 of that, which gets added into all of their other medical expenses into a big blender. And then the IRS says only the amount of all of that over 7.5% of AGI do you get to deduct. So not going to be really exciting probably for somebody under 60. Now, 60 and above, now premium deduction is almost $4,800 a person. Still have to have the 7.5% of AGI, but for a couple, $4,800 times 2, throw that in there, it may start to be there. But we have this age-based limit that especially probably hamstrings younger people. What if our astronaut happened to be a self-employed or a sole proprietor? Well, you get a little break. Not subject to the 7.5% AGI. So it becomes an above the line deduction, but you're still subject to the age-based premium limits. So helpful. But again, 50, if you're in your 40s or 50s, it's not necessarily going to make or break anything. S Corp owners, same idea. Limited to the age-based premium limits, above the line self-employed health deduction, health insurance deduction. So, better than a stick in the eye, but not great. Partnerships, LLC business owners. Guess what? Same thing. Deduction still subject to the age-based premium limits, above the line self-employed health insurance deduction. So you're thinking, Mark, this is okay. These are all okay. These are not necessarily what I would call a bargain. But just wait for it. The bargain comes down to when there's a C Corp. C Corp has probably, and I'm not a tax person, I'm not a CPA by any way, shape, or form, but this might be one of the best tax benefits out there. There's no downside to it that I can find. So for a C Corp, premium payments are 100% deductible from the corporate tax return. So just like income, anything else, it's great. It's exactly what you would want. Can't really get better than 100% deductible. Now here's the magic. It's not limited to the age-based eligible premiums. So it's treated like traditional health and accident insurance premiums. No age-based limitation. 100% deductible to the business if they pay it to the insurance company. No age-based premium limits. Shareholders, W-2 employees, all eligible. You're thinking, okay, if the business pays the tax, if business gets to deduct it, somebody else has to take it as income, usually employee. No, employer paid long-term care insurance is excludable for an employee's gross income. Business gets to deduct it for an employee doesn't have to recognize it. You're thinking, okay, now like disability insurance, if somebody else pays for it, then when somebody receives the benefits, it's going to be taxable. Nope. Benefits received are still tax-free because it's long-term care. So this is sort of a tax trifecta, whatever a four thing is, quadruple. Not a big betting guy, so I know trifecta. It covers everything. 100% deductible to the business, can cover employees, even spouses, dependents. Employee doesn't have to take it as income. Benefits are tax-free if they're ever used. So this is a really, really, really neat benefit plus to long-term care that when you have a C Corp. Unfortunately, you have to have a C Corp. There's your catch. But when you have a C Corp, it's pretty amazing. So we're going to take Han and Leia at age 50. They look really good for 50. I don't look that good. And I'm not 50 yet. But I guess in space, maybe a different atmosphere, a little more moisture in the air so you don't get as wrinkled. They happen to be C Corp owners here in Florida. And what they want to do is look at a joint life long-term care policy. A traditional long-term care policy is going to work fine too. But in this case, we're looking at a life long-term care policy because they have kids and they want to make sure that this idea of, well, if we're going to pay these premiums and we never need the care, I'd like there to be something for the kids. So we get to do that with the life long-term care policy. And because they're C Corp owners, we're going to get to do some really cool deductions. If we look at this policy, $5,600 a month, covers home care, assisted living care here in Florida. It's not going to cover the more expensive nursing home care, but it's going to cover some of that. 3% compound inflation rider and 6 years of shared benefits. So Leia can use one, she passes away, Han has 5 years of benefits left. Leia can use 5, pass away, Han gets 1. So neat thing. And there's this life insurance death benefit if they never need it. Their C Corp business, it's a smuggling thing, but I guess, in space, you can be a C Corp and still be a smuggler. So Han's doing really well at that. They look at this policy, $5,600 a month, 6 years shared benefits, 3% compound inflation, had a really good year this year. So they're going to say, can we do a single premium this year? Rather than distribute $120,000, $130,000 to ourselves as bonuses or other forms of compensation, is there a cool tax way or a cool tax option to not have to recognize all of that? And yes, there is with this policy. What's really cool about this particular policy is it breaks out the cost for the life insurance and the long-term care premiums. So they're having a really good year, have money in the bank, might just bonus it. If they bonus it to themselves, pay themselves, they've got to pay taxes on all that. If the business pays the long-term care, and then they bought a long-term care policy. If the business pays for it, the business gets to deduct it. They don't recognize any of it. So of this bonus money, they're going to have the business pay for Han's LTC premium, that's $37,000, Leia's LTC premium, another $57,000. So the business is going to pay $94,000 for this policy. Business deducts it 100%, not included on Han and Leia's in tax returns at all. They could have the business pay $29,000 additionally and recognize that as income. I probably wouldn't. I would make it clear. I would keep it cleaner. I would have the business write the premiums for the long-term care portion, and I would have Han and Leia write a separate check for the life insurance component, $29,000. So Han and Leia write a check for $29,000 and get $123,000 of benefits through this long-term care plan because the business paid $94,000. Pretty cool. What if they aren't sitting on that much cash? It's all right. We can do it in 5 years. And again, the policy breaks out what is the long-term care and what is the life insurance premium. If we do it over 5 years, Han and Leia are writing $6,600 checks for 5 years for the life insurance component, but the business is writing almost $20,000 checks for all the long-term care benefits. It's just amazing. They're not recognizing $20,000 of income for the next 5 years. 10 pay. They're 50, want to retire by 60, so 10 pay may just work. They have good cash flow, but maybe not big checks. $14,000 a year. Han and Leia are writing $3,800 checks. The business is writing the other $11,000 every year. The business is paying the premium for the long-term care and deducting it. They don't recognize it on their taxes. It's really cool when we can do that with the C Corp. So Bill talked about this in the book. Instead of saving these big piles of money to pay for care when you need it later, use your money now to purchase long-term care insurance. Even better, if somebody happens to have a C Corp, use tax advantage money. So I mentioned this retiring with X idea. Bill's book is all about dying with zero because you're spending down money. But so you have to retire with X and spend it down for Y years to die with zero. So we look at Han and Leia, both now age 55. So now that looks a little bit better. Ready to retire this year, how much do they need? And we need to figure it out because space eggs sure are pricey these days. I mean, we think eggs are expensive here on Earth. Whew, in space, no one can hear you scream when you pay for eggs. So how do we retire with X? What is our X? What is that number? Well, you can sure go down a black hole trying to figure all that out. And you can end up like people like I used to do growing up in the line, standing at Blockbuster, looking at stuff. and trying to figure it out, and eventually get lost. And you go down this black hole of trying to figure out, what is my X? How much do I need? So that was really just an excuse to use a Blockbuster ad commercial or a Blockbuster picture. So luckily, your clients have you. They're outer space financial advisors who are going to help them. Maybe you're not all robots. Maybe some of you are, but they're going to come to you. But Bill's book, of course, he says, everybody's going to ask me, how much do I need? It's kind of hard not to have that in the book. And he came up with a number. So what is Bill's X? He came up with this survival threshold number, 0.7 times the cost to live 1 year times number of years to live. So Han and Leia, their expenses are $5,000 a month. So using his calculation, we came up with $1.68 million. Okay, so that's our starting place. That's what he says somebody should have in the bank. But then he also mentions annuities. And so annuities are giving some of that money to an insurance company in exchange for income. And it looks just like that. Money goes to an insurance company and makes annuity payments until death. So if we looked at an immediate annuity quote, if we wanted $5,000 a month through an annuity, how much would it be? So Bill says we need $5,000 a month, $1.68 million. I will cover that $5,000 for as long as we live. We can actually give it to an insurance company and get a better deal. This is $5,000 a month, 900, little under $1 million. Now, Bill's number is probably going to have inflation and things built into it. This doesn't. So if we separate the two things, we could, in theory, take part of the money, $1 million of it, to an annuity, have that $5,000 a month for as long as they live, and the other $600,000, $700,000 is invested. It grows with inflation, pays for trips, expenses, emergencies, things like that. I'm not saying that X is a number. I'm not saying 1.68 is a good number or a bad number. It's just a number using the book. So I'm trying to break it out into two different components. Kind of like there's not a fuel efficient Humvee out there, or a Prius that you would necessarily want to tow a boat with. Having a big pile of money is great. An immediate annuity is great to guarantee a lifetime income. So Bill's idea is, don't die with a lot of money, maximize your income. And an annuity helps you maximize that income and know you can't outlive it. So $978,000 gives them $5,000 a month. I wouldn't put all my eggs in one basket. So what if we just wanted to do baby steps? $1,000 a month is $196,000 a year. I found this website that says, doing some different assumptions, if you have $1.68 million there, I don't know if anybody can see my cursor there hovering over there, but if you have $1.68 million and you need $60,000 a year, you're 55, you're going to live for 40 years, eventually run out at age 94. Okay, so that kind of lines up with Bill's number pretty darn well. I took it a step further and said, what if I take $196,000 out? I did, so that's 1.484. And I don't need $60,000, I need 80% of that. So 80% is right below that. So now I took out $198,000 and I only need $4,000 of monthly income. Well, now this report says I'm going to have a surplus of $890,000. A lot of numbers here, it's kind of small and hard to see, but I took enough to buy 1,000. I needed, with my first slide, I needed $5,000 a month, and I ran out at age 94. I took out what I needed to guarantee $1,000 a month. I take what's left over to provide me $4,000 a month, and I have a surplus of $890,000. I do it for 50%. So I need $60,000 a year. I need $30,000. I took out enough to buy a $2,500 annuity, and I have $2.2 million left over. What is all this saying? It's saying that when someone needs guaranteed income, an immediate annuity is good. Is it going to be all of it? No, I wouldn't put all my eggs in one basket. Most insurance companies won't even have a cap of 50% of your investable assets, which is good. So shouldn't do all of it, but especially if we're looking at something like wanting to retire with X, not have lots of money left over, an immediate annuity creates this income stream that you can't outlive and makes all of these things work better. Does it work for inflation? Not really. That's why you keep other assets. So it's just one lever we get to pull with this overall idea. If we truly didn't care about leaving anybody any money, yes, you would maximize the annuity. Didn't really want to inflate. You get there and take 1.68 million and say, yes, guarantee as much as I can. That would work. You should have some of both. Some income stream, some flexibility investments. But using a little bit with an immediate annuity increases, it bumped up. Instead of running out $1,000 of immediate annuity per month and what it took to purchase that, kept the plan from either falling apart at 94 or ending up with an $800,000 extra. Pretty amazing. So yes to SPIAs, yes to this idea of die with zero, an immediate annuity. I give all the money to the insurance company for an income stream so that whenever I die, there's nothing left in that annuity. There's also this idea of deferred income annuities. So rather than getting to age 60 and saying, I'm going to write a hundreds and hundreds of thousands of dollars check to get $3,000, $4,000, $5,000 of monthly income, I might do this at different stages. I really like this idea. I want some income, guaranteed income. I'm going to use an annuity to do it. You can purchase what are called deferred income annuities. So I'm not doing all this once, but I start layering these annuities as clients hit certain accumulation goals. They still want to retire at age 60. They want to die with zero. They have that $5,000 monthly spend need at age 55. So a deferred income annuity, this has it going out to age 85, but instead of an immediate annuity where I give the insurance company money and they start paying me right away, I give the insurance company money and it starts paying out at some future date. So what happens? They start accumulating. They like this idea of income in the future, still want to retire at age 60. So at age 48, their income, they've saved hundreds of thousands of dollars. We like this idea, we want this income. At age 48, they can purchase an immediate annuity that defers 7 years to pay them $1,000 a month starting 7 years for $143,000. And as you'd expect, the longer between when I give the insurance company money, they have it sit and earn money and start my income, the lower the rate is. So at age 50, they've hit another retirement goal, savings goal, transfer $158,000 for a new payment of $1,000 a month starting at age 55. And as they get closer, they do it. And as we used the number before, when they're both age 55 and starting now, it's $197,000 for that $1,000 a month. So it's just a cool way to say, yes, part of our plan is going to be guaranteed income. Using Bill Perkins' idea of dying with zero, an immediate annuity does exactly that. I give the insurance company, they're going to pay me for as long as I live, 5 years, 10 years, 100 years. But with this, I'm going to die with zero. So SPIAs boost that retirement security, whether you're part of the FIRE, the die with zero, and of course, clients of Fieldly Financial Advisors. When we look at, does it need to be a lot? Does it need to be most? No. Is there some benefit to having an immediate annuity for almost everybody? Probably, unless somebody is in poor health. But that immediate annuity is going to have that lifetime income stream they can't outlive. And so you get to know that it's there, and it just bumps up all of those retirement income projection numbers. So thank you everybody for attending today's Zero Gravity Insurance Strategies to Die with Zero. I thought of this from the end of Star Wars. It looks kind of like a zero there at the end, but you want the whole financial plan to just explode at the end. In Bill's idea, you don't really want anything to be left, like the Death Star. Nothing left. At the end of it, I had maximized my experiences using all of these things so that I was covered if I needed care at the later years, annuities to guarantee that those income streams. So thank you everybody for tuning in today, and we'll see many of you all at different conferences throughout the year. The NAPFA, Garrett, XYPN Live, ACP, and NAPFA Fall. And I believe it's Jerry and Taylor at our office will be the attending the first conference in May. And we have more space-themed annuities coming this year. Next month is Misha, who's going to be talking about navigating the mysteries of underwriting in space. And then Taylor in June about protecting the aging planet, the world of long-term care. And then if there are any other questions, feel free to type them in the box and I'll have Valley relay them to me. All right, not seeing any other questions. Thank you everybody for tuning in, and hope to have all of you all tune in next time. Oh wait, 1 second. Hold on. The long-term care scenario with the C Corp is only for pure long-term care insurance, not hybrid policies. No. So that's the really cool thing about that particular hybrid life long-term care policy. So a traditional long-term care insurance policy would work with a C Corp. So insurance companies file their either long-term care or long-term care rider in a particular section of the Internal Revenue Code. Traditional long-term care policies, yes, 100% deductible like C Corp. That particular policy nationwide, there's also files under the true long-term care IRC code, so that's good. And then it breaks it out what the not all insurance companies do it that way, where they break out what is the life insurance cost and what is the long-term care cost. So it may not always be as clearly definable, but in that case, Nationwide's actually does. The long-term care rider is the same Internal Revenue Code section qualifier as traditional long-term care, so they filed it that way, and then they break out the identifiable long-term care premiums compared to the life premiums. So in my scenario, I used a hybrid life policy because it's broken out that way and we can do it that way. What is the death benefit in that example? Is it second to die? Yes, it was a joint policy because I used it on Han and Leia. Let me see if I can. Ooh, what a good guess. I guess slide number 21. Here it's the third line down, specified amount 201,600. So that's the life insurance death benefit component. So Han and Leia will have put in $123,000. The business is deducting that long-term care premium section. This is a, like I said, hybrid life long-term care policy, so perfect. If they never use it for long-term care, then there's a $201,000 death benefit that passes at the second death, because we want Han and Leia to be able to use the long-term care themselves, both be able to use the long-term care. It's a second to die policy. We wouldn't want to have Leia die and have death benefit go to somebody, their kids, and Han not be able to use the long-term care. So it's a second to die life insurance policy with the long-term care rider that's identifiable to pay the premiums for. Put in $123,000. If they never use long-term care, they get $121,000. Their kids get $201,000. If they use care, then what happens is that $201,000 is reduced dollar for dollar by long-term care payments made. So if Han and Leia use $100,000 to long-term care, pass away, their kids get $101,000. If Han and Leia use $250,000 to care from the policy, nothing goes to the kids. Great questions. We land on an ideal amount to be invested in a SPIA for a typical client. No, there's not necessarily an ideal amount. Things I would look at are what are someone's what we might otherwise call fixed expenses. I know every month I need to buy groceries. I know I've got a Verizon bill. I know I've got a cable bill. So that would sort of be a floor. I think everybody is going to be able to come up with some expenses that they know they have every month. My cell phone bill fluctuates a little bit. It just seems to go up. But to me, what's the ideal amount? Sort of those base we might otherwise call fixed expenses. As long as I'm alive, I'm going to have an electric bill. And whether it's at my house, in an apartment, even if I move to an assisted living facility, part of my monthly expenses and rent will be that electricity. So what is an amount? That's where I would start. Now that might be high for people. I wouldn't try to build in things like, oh, and they probably spend $12,000 a year on vacations. I wouldn't use that with the annuity because I think that's going to decrease in those slow-go years, maybe in the no-go years. And then we're trying to guess what are those things that, well, we replace medical expenses, care expenses with, we replace care expenses with, for the travel expenses. So I look at almost fixed utility kind of amount. So that would be the idea of what I might do as far as working backwards. What are those fixed expenses every year to look at a SPIA? What are my thoughts on how SPIA affects the asset allocation of existing investments? Getting a little beyond the scope of my things, but insurance companies, when you give them money, they're investing it in fixed interest, fixed rate investments. So to me, anything I would put in a SPIA would probably be more akin to my fixed rate account, fixed income accounts, because technically it is fixed income, and I use equities to adjust for inflation. So I probably would lean, that's probably how I would think of it personally, is that if I start using a SPIA, that's more of my fixed income bucket, and then I would probably then end up heavier on equities and whatever's left over. C Corp tax advantage only works if the insurance company separates out the premiums for long-term care and life insurance. Right. The reason that Nationwide did that in their plan and other insurance companies are looking at this idea is because for this reason. If it's not broken out, there's not a way to identify what amount is long-term care, what is life insurance, because it's a hybrid plan. Here, Nationwide in particular breaks it out so it's very, very clear. Let's see, it says single premium quote for Han and Leia, but example that says annual premium, just a one-time payment. Yes, it's annual payment, but yes, this is a one-time. If you look up, yes, it says annual plan premium. It could have been monthly or quarterly, but if you go above the big blue separately identifiable, it says premium payment period, single premium, one time, 123,767 annual. So yes, not ongoing premiums, single premium. And we're over time. I am happy to keep answering. Oh, Valley told me that's all of them. So thank you everybody for tuning in. Everybody, hopefully I got, if you asked questions, hopefully you hung around a couple extra minutes to listen. And thank you so much, and we'll talk soon. Bye.